Hi, it's Larry Gaines from Options on the Open. We are the leaders in day trading and swing trading using options. As a trader, it is always important to have a trading plan to help you navigate different market scenarios. Markets can change slowly or violently, and it is important to have a plan in order to respond quickly to these changes. We are currently in a really nice market uptrend that started another major leg up in September of 2010 and has been steadily moving higher with just a few small corrections on the way. We had this small little correction down a little over 4% back in November 2010, and then we had this pretty good correction here of over 7% right here from the high back in February at 1344 on the S&P down to this low right in here at 1248, and this all came due to the Japanese crisis and the nuclear potential meltdown. So since this market high back in February at 1344, there have been several events that have happened that have spooked the market. The one I just mentioned, Japan, and now we're currently still experiencing tension in the Middle East and North African areas, which has pushed oil prices now well over $110. Let me pull that up. So here's a chart of the May WTI futures contract, and as you can see here, we've had a major extension on Friday over $110 per barrel, and currently up over $112. Gasoline is nearing or over $4 in a lot of the states, and there's a potential, if we continue to see higher oil prices move higher than this and even stay over 110, we will eventually probably see some kind of demand destruction. Now, another factor that is on the sights of most traders and institutions right now is at the June time frame will be the end to the quantitative easing 2 or QE2. This Fed program has had a major impact on the markets, keeping interest rates low, which has created a floor to the markets and a green light for the markets to move higher. With this nearing an end, will traders and institutional money managers start to rebalance their portfolios by reducing their net long stock positions? Even Apple, let me pull up Apple. Even Apple has lost its momentum and its mojo. And here's Apple. Even Apple has lost a lot of momentum and started to roll over. I mean, will it continue down, or will it find some stability and move higher? These are a lot of factors in the market which are starting to puzzle traders and institutions. So, are we set for a downside pause, or a pause in the market, or potentially a downside correction? Well, nobody really knows, but there are quite a few signs that say to be careful and to watch out. And since we don't know, but we know that there could be potential turning points in the market, we need to have a plan. And going forward as a trader, you need to plan for different market conditions. So I would like to throw out a couple ideas here for the market if the market does start to move lower or even go sideways. A couple of trading ideas that might help you to hedge your portfolio or even participate if there is some kind of downside correction. There are two ETFs that I like to use for hedging purposes, for protection to the downside, or even for trading for downside movements. And one is the TWM, which is the ProShares Ultra Short Russell 2000. This is the inverse of the Russell 2000, which is the IWM. So let me pull that up and I'll show you the IWM. Okay, this is the IWM, the Russell 2000 ETF. So this is 2000 smaller beta type, smaller cap stocks that have had a huge move up, and they've had experienced a great uptrend. Now, if the market does decide that it's time to take a breather and perhaps correct, this is one ETF that will experience probably the fastest move down because of the cap size of these stocks. They're high beta, and they usually will tend to move a lot faster to the downside, and when the markets correct and start moving back to the upside, they usually tend to move higher and faster as well. So to play this one, you can use the TWM. And here's the TWM, the inverse fund. So as the IWM, or the Russell 2000, goes down, this will go up. So this is one ETF to keep in mind. The other ETF is the SDS, which is the ultra short S&P 500 Pro Shares. So as the S&P 500 goes down, this is the inverse, this will go up. So these are just two ETFs that you can use to help yourself trade a market move to the downside if that does happen. And I just wanted to throw these out to give you some ideas. So no one knows for sure where the markets are headed, but just be prepared and have a trading plan. And if you'd like, please come join us at Options on the Open. If we're going to trade any of these funds, we will use options to do it. So please join me at optionsontheopen.com, and thank you for your time.